On this hot sheet, I discuss NAR's existing home sales report just released and the demand for urban real estate going forward. Today is Friday, July 21st, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome back to another hot sheet live stream, and good morning for all of those on the live stream. Let me know which market you're tuning in from. I see Houston. I saw South Carolina in the house. Hope all of you are doing well. If you're listening to the replay on Apple or Spotify, please consider giving the hot sheet a review. We've done over 100 of these. We're live every Monday through Friday, 9:30 a.m. Eastern, the only live daily housing show on the internet, by the way. And I don't know, I never recognized the Apple Spotify people. So if you're somebody who will sometimes mix it up and listen to the replay on podcast, please consider giving that a review. And let's jump into the National Association of Realtors existing home sales report just released yesterday after we went off of our live stream. I'll go over some of the key highlights and then we'll dig deeper into the data, specifically which of the four regions is doing the best in the U.S. housing market. Existing home sales dropped 3.3% to June to a seasonally adjusted annual rate of 4.16 million. Sales trailed off by 18.9% from 1 year ago. That 4.16 million seasonally adjusted rate, they adjust that every month. Okay. And so that's the total number of sales in a 12-month period. It's the lowest we've seen in quite some time. Okay. Doesn't mean that the world's coming to an end. Real estate agents, there's plenty of deals out there. 4.16 million. You always times that number by 2. There's 2 sides to every deal. Imagine if there could be 3 sides. I don't think that's possible, but there are 2 sides to every deal. So you're talking about 8 million plus opportunities for agents. At $410,200, the median existing home sales price for June was the second highest price ever recorded since January 1999, when NAR began tracking the data. It was 0.9% less than the all-time high from 1 year ago of 413,800. So we just saw this with Redfin's data, and now we're seeing it with NAR's data, where in this particular month, the month of June that just happened, we're seeing a record month, a second place to the record. Last June being the record for NAR, and this June being the second place record for median home sales price. Now, existing homes is different than what we talk about with new homes and new construction. Obviously, this is when somebody takes their home and sells it into the market. It is a resale onto the market, something that has already been lived in by someone, to put it more plainly. It was the third time the monthly median sale price eclipsed 400,000. So June 2022 being the record, and May 2022 now taking third place on the list. So 410,000. Prices continue to go up despite total sales continuing to drop. At 1.08 million at the end of June, the inventory of unsold existing homes was unchanged from the previous month, or the equivalent of 3.1 months supply at the current monthly sale price. We know that 1.08 million at the end of June is very misleading the way NAR does it. That is the total active listings, as well as all of the homes that are under contract. After active listings is closer to 460, 470,000 that are on the market. So if you're a consumer and you're looking on Z or RDC or one of these places, you're seeing those. You're not, you can see the other ones, but it's saying under contract, not taking offers anymore. Don't call me, get away from me. All right, let's take a deeper look at some of this NAR data. All of the slides I'm about to go through, they're available in BAMX on our daily download. All of our daily downloads for the hot sheet are in one place. It's BAMX. Use code Jerome, which will be good through till he announces what he's doing with the federal rate next week. So Jerome, Jerome, gets you 10% off your membership to BAM X. You get all the daily downloads every day with the hot sheet, all of our courses, all of our live streams, and the private Facebook community. You get direct access to myself, Eric, and the rest of the BAMers. Okay, so this graphic is in there. Everything's down month over month, year over year on total sales. Inventory's up. We like that. We want inventory to be up. Prices continue to inflate the less inventory we have. Median price of existing home sales, again, hit the second highest month on record, going back to 1999 from NAR, and well above, pre-pandemic level. Just look at this in 2020, right before, March of 2020, 274,500 was the median price of existing home sales. And we're currently in June at $410,200 for the median sale price on existing real estate. This is starting to catch up too, by the way, to new construction. The median sale price on new construction is $450,000, and we're at $410 for the month of June, albeit 1 month where you're going to have the highest, month probably of the year in June. But the median sale price on new construction is $450,000, closing that gap because new construction makes up 30-something% of the inventory. That's how little inventory there is for existing home sales, which is why that price isn't budging. Everybody has said, oh, there's a 20% cliff coming on existing home sale prices. And it hasn't happened because we have no inventory. So that price continues, obviously, to inch up. Total existing home sales, again, getting closer to the low peak or the low point for that number. You got to go all the way back to 2020, obviously, when the world stopped, to have a seasonally adjusted annual rate of home sales this low. Of course, we've been experiencing this here now for the better of the last 7 to 8 months on the total sales. All right, here's another way to look at existing home sales, total sales, okay? You can go month over month. You see January, the seasonally adjusted rate was up over 6 million last January in 2022. We were at 4 million this January. February and March through June tell a similar story. 2022 declining, but even in June of last year, we're up over 5 million on the seasonally annually adjusted rate for existing home sales. We're sitting just over 4 million really throughout the entire year. We showed projections of where this will go in the future on past live streams. It's going to take a couple of years for this to really start to inch back up anywhere close to this 6 million level. Really, just to get to 5.5 million, it's probably going to take 2 years. The good news is there are signals that number has really bottomed out. So while it'll be a slow climb up month over month over month over the next, call it 24 months, we will be trending in that direction. There's not going to be, without some unforeseen circumstance, there's not going to be, this crazy ride up to 6 million like we saw in 2021. Okay. And there's really no inventory to support some crazy ride. So it would take something that nobody has ever thought of, like what happened a couple years ago, obviously. Existing home sales, looking from 2019 all the way till today, year over year over year. Another way to look at this, we're really here in 2023, pretty close to this number here, the minimum number of home sales. Okay, you can see in June, those lines are almost even with each other for the bust, right? So the minimum amount of home sales, the black line would be the maximum amount of home sales during the bubble, which was much higher than 2021 and 2022. There were so many more home sales happening during that max bubble time frame before the great financial crisis than there even was in 2021, 2022. So just another way to look at where we're at for existing home sales. Still, one thing about being a real estate professional, there are still plenty of sales happening. There's still plenty of them to go around. Okay, I actually put out I think a thread or a tweet. I can't remember. I think it was a thread giving out Steve Harney's breakdown. Even with the 4.16 million home sales, which we're at right now, a low point for seasonally adjusted home sales, he said 11,397 houses sell every day. Okay. So you divide that by 365 days, means 475 homes sell in an hour. It also means over 8 sell a minute. So every minute there's 16 sides available in the country. Now I get it. 1.5 million agents are competing over 16 sides, but that's every minute. Nobody's selling a house every minute. So a lot of opportunities out there, despite the fact that there are not a lot of homes on the market. This is the existing home inventory, which not only has been on a real decline the last couple of years, this has been a declining market of inventory since 2000 and call it from the peak of 2007. It's been on a straight decline. But really, even if you look at 2011, it has just been a consistent and slow and steady pace down. Can't build enough single family homes. They're building plenty of apartments, but they couldn't build enough single family homes to support the situation that we're in right now. It's why the builders, and we talked about it, I think, a couple of days ago. For the last month, the numbers just came out where housing starts and building permits were down after being up the month prior. So builders are being very conservative. They're taking advantage of this market. They're not putting themselves into the position before the great financial crisis at all. But that doesn't help the inventory issue. And there's really no signs going forward that there's going to be this burst of inventory until rates come down closer to 5.5%. It's kind of my golden number. How do realtors feel about this market? First time Realtors Confidence Index survey from NAR, percentage of sales right now, 27% being first-time homebuyers compared to 30% last June. Sales to investors is up, according to Realtors, 18% in June compared to 16% last year. Let me know in the comments if you agree with these numbers in your market. Realtors believe 26% of their sales are cash sales compared to 25% in June of 2022. Love to know on the cash number, is 1 out of 4 of your closings right now cash deals? Is it more? Is it less? Let me know in the comments. Distressed sales up, up a double up. Okay, 1% were distressed last year, now 2%. Okay, so a double up there. Not really a big number, obviously. And then days on the market is up to 18 compared to 14 for last year. Okay, last thing we want to look at here with the NAR report is which region of the country, out of the 4 major regions, U.S. housing market regions, which is doing the best. Okay, we've got obviously the Northeast, the Midwest, the South, and the West. Which of the 4 regions is performing the best in the housing market? You can let me know in the comments right now where you believe the best regional market is. And let's go through now what NAR thinks. Existing home sales in the Northeast grew 2% from May to an annual rate of 510,000 in June. Okay. That's down 21% from June 2022. The median price of the Northeast was $475,300, up 4.9% from the prior year. So the Northeast right now is up almost 5% year over year on median sale price. It's at $475,300. It's well above the national median price of $410,000. So there you go for the Northeast. Let's take a look at the Midwest. In the Midwest, existing home sales were unchanged from 1 month ago at an annual rate of $990,000 in June. That's down 19.5% from 1 year ago. The median price in the Midwest was 311,800, up 2.1% from June 2022. So the Midwest is up 2.1% on median price from June 2022, which would be year over year. Okay. Existing home sales in the South faded 5.4% from May, annual rate of 1.91 million in June, a decrease of 16.2% from the previous year. The median price in the South was 366,600. Now that's down 1.2% year over year. So the South down, according to NAR, 1.2% on price, while Midwest and the Northeast are up. In the West, existing home sales declined 5.1% from the previous month, annual rate of 750,000 in June. It's down 22.7% from a year ago. Now, the median price in the West, listen to this, median price in the West, $606,500, which is down 3.4% from June 2022. So the Northeast is doing the best in median home price growth, has the biggest gainer of almost 5% from the prior year. Midwest is the only other region that gained year over year, up 2.1%. The South and the West both declined. Now, the South and the West, the South has the least decrease on total sales. So they have more transactions happening. That does have a lot to do with the fact that for the Northeast being down 21.5%, for example, on total sales, that the Northeast is the lowest region for inventory. Many of the states in the Northeast are closer to 2 months of inventory. And we just looked at the national inventory numbers are now up over 3. They're up to 3.1 from 2.9. That's not the story in the Northeast. That has a lot to do with that home price, that median home price continuing to increase. So in terms of home prices, Northeast takes the cake here on this monthly NAR report. But let me know, which region do you think is performing the best right now? There's more sales happening, obviously, in the South. There's a lower decline in the South, so you could certainly argue that there is, more movement there and more people. The trend is continuing that more people are moving there. We've got a quote from NAR chief economist Lawrence Yun. The first half of the year was a downer for sure, with sales lower by 23%. Fewer Americans were on the move despite the usual life-changing circumstances. Spring is a time when a lot of people move. The pent-up demand will surely be realized soon, especially if mortgage rates and inventory move favorably. Inventory won't move favorably unless the mortgage rates do. We're going to take a look at the rates here in just a little bit. But before we do that, let's take a look at what the demand is going to be like in our cities, our U.S. American cities. What's urban real estate going to look like moving forward? We've been discussing a lot about commercial real estate, how if there's going to be any bubble to burst in real estate, it's going to come from office buildings specifically. We've covered this at length. A lot of buildings in San Francisco, people have just walked away from those buildings. They've given up their debt obligations and taken the hit. We also see that happening in cities like New York City. Fortune came out with a piece that says demand for urban real estate will be challenged for the rest of the decade, not only the rest of the foreseeable future. Here's how the world's superstar cities are projected to fare by 2030. I do have this down below, along with all of those NAR slides for you in the BAMX daily download. Get it all in one place. Use the code Jerome for 10% off. Some of these cities have more than 10% of demand decreasing on a projection in the future. Office real estate from 2019 to 2030, Houston and Beijing are the only two that have a projected increase for office demand over the next decade, 2% each. Tokyo, London, Paris, Shanghai, New York City, Munich, and San Francisco, all double digits. Tokyo's negative 9%, but everybody else double digit projections in the negatives for those cities for office real estate. Okay. San Francisco being the leader at negative 20%. That makes sense, seeing as how San Francisco has already been taking the biggest hit of any U.S. city. Okay, how about retail real estate? Shanghai is the only major city, superstar city, as Bloomberg puts it, to see an increase at 1%. Tokyo, Houston, Munich, and Paris are in single digits at negative 2%, negative 3, negative 3, and negative 9%. Beijing, New York City, San Francisco, and London all double-digit loss in demand for retail. New York City being at negative 14% for retail, to me, is surprising, because I think New York City is still doing quite well with tourism, and tourism typically will bring in retail sales. San Francisco at negative 17% makes sense. We just covered San Francisco earlier in the week. There's a migration outflow happening in San Francisco. There's an office building outflow happening in San Francisco. There's no signs of that turning around. And so that one's not surprising to me. London is negative 22%. Now let's look at residential real estate. And what's the demand going to be in these superstar cities? Because if there's less demand on offices and less demand on retail, you got to imagine there's going to be less jobs and less demand for people to want to live inside of those superstar cities. But these numbers might surprise you. Houston is 26% in the positives for demand living in over the next decade for residential real estate. Tokyo up 12%, Munich up 8%, London and New York City are both up 6% for the next decade for residential real estate. Beijing 5% increase, and Shanghai 3%. San Francisco and Paris are the only two in the negatives. San Francisco at negative 2% and Paris at negative 4%. When we look at San Francisco being in the negatives of all three categories, I'm not trying to beat up on San Francisco, but you can follow the trend in home prices. Take a look at this chart from Fortune. Shift in home prices this decade has San Francisco up 23.4% for the decade. It's a phenomenal number, but it certainly doesn't match that of Miami, Florida, which is the most popular city for inbound migration in the US. Miami is up 56.8%. This is a change between December 2019 and June 2023 on home prices, while San Francisco is only up 23.4%. Our consumer price index is up 17.5%, CPI, inflation, in other words. We want to see that get lowered, but San Francisco trending closer to the CPI than the leader of all cities in America, which is currently Miami in growth and in price growth as well. So there you go, a little update on what this office decrease, this decrease in office demand is going to do for residential. There's not a strong belief that the cities are going to crater on their residential demand. There's still a lot of people that want to be in these cities. I've been saying this for the last 3 years straight about New York City in particular. New York City is not going anywhere. There is a debate, I think, about some of these other cities, maybe San Francisco in particular, and we covered that on a previous live stream. You can go re-listen to that, where we make the comparisons off of that Bloomberg article between San Francisco and potentially being the next Detroit. Okay. Let's take a look at where the 30-year came in yesterday. Unfortunately, we hit 7% again. So we've had a week and a half on the daily survey where we've been under 7%. We hit exactly that yesterday. The Freddie Mac 30-year fix for the weekly came in much lower because of those daily surveys over the last week and a half. So down last week from 6.96 to 6.78 on the weekly survey. So that's good news there. Let's see if we've got any good news here today on the 10-year. It is down a little bit, but it's still up over 3.8. That's going to keep us relatively close to the 7% number on the 30-year fix. We're watching the 10-year closely. Obviously, as this moves down, we should expect the 30-year to go down and expect more opportunities for better lending and more money into in coming into real estate, and potentially some more people deciding to put their house on the market. If you're not in BAMX yet, use the code Jerome in honor of Jerome Powell and the Federal Reserve as they meet next week on Tuesday and Wednesday, the 25th and the 26th. We'll be covering it all here on the hot sheet. And Monday's hot sheet, I'm going into deep detail setting up the conversation of how inflation and the almost guaranteed increase coming next week is going to impact real estate. You do not want to miss Monday's hot sheet if you're into this inflation story and following that on how to prepare for your real estate investments or your real estate business. So make sure you subscribe to the channel for that. Also, if you're a real estate agent, make sure you join me in August. I'll be at the Tom Ferry Summit. I go every single year. It's the Super Bowl of real estate events, and you can get the lowest price anywhere using our link below and our code PRBAMSS. PRBAMSS. Use the code, get $100 off of the ticket. Join me in Dallas and the rest of the BAMers as we do a BAM Bash on night one as well. If you're a BAMX member, you're getting first dibs on BAM Bash. I think we're releasing that into the BAM community, the BAMX community today or tomorrow. It's Eric's job, the broke agent. So as long as he doesn't sleep till like 2 p.m. today, we'll get that up. He's not. He's actually in the West Coast, by the way, and he gets up our time. So he's getting up at like 4:35 a.m. every day, if you can believe that, from the broke agent. All right. Hope everybody has a great weekend, and hope to see you in BAMX if you're not already there. And till Monday, toodaloo.